Next, as promised, we'll talk about why a company might select one method over another. So first, let's start with the FIFO method. FIFO again stands for first in, first out. Now, some of the attributes of this method you may have already noticed from that quick example we worked through. Look at the cost of goods sold for FIFO. When you compare it to the cost of goods sold for all the other methods, it's the lowest, right? It is the lowest. Okay, $3 compared to $4.50, $3.75, and $4. So it's the lowest. Okay, so first in, first out method will produce the lowest cost of goods sold. Now, if we have low costs, what does that mean for our net income? It'll produce the highest net income. And I need to qualify this by saying, assuming costs are rising. Okay, but that's pretty much a blanket assumption. You know, obviously in our example, the prices rose over time, but also just inflation, right? Ask your grandparent how much they had to pay for anything, gum, milk, gas. It was a lot less than we pay now because prices tend to increase over time. Okay, so assuming that costs are continuing to rise, the first in, first out method will produce the lowest cost of goods sold, which creates the highest net income. What about assets on our balance sheets? On our balance sheet, compare FIFO to the other methods. FIFO produced the highest inventory balance. Okay, so FIFO will produce the highest ending inventory balance. Again, assuming costs are rising. So there's some great attributes. So maybe now you see why the first in, first out method is the most popular. It gets the most popular award. Okay. Maybe it's because it produces the high net income and produces the largest asset balance, right? Those are usually attractive measurements that companies look for. Also, it's pretty easy to understand, right? Most grocers, people that deal with perishable items, even us as consumers, right? When we're eating food in our fridge, we look for the stuff that's probably going to go bad first. So it's probably what we purchase first. So first in, first out. So it's easy to understand. So those are some of the characteristics of FIFO. Now, let's look at LIFO, or last in, first out. Again, assume your costs are rising. It's basically going to be the opposite of FIFO, okay? And we can illustrate that with our example. So if we go back to our example, look at your cost of goods sold. Which method produces the highest cost of goods sold? LIFO. Okay, produces the highest cost of goods sold. If you have high cost of goods sold, what does that do to your net income? Produces the lowest net income. Again, always assuming that costs are rising. What does that do to your balance sheets? Well, let's go back and look at our example. Okay, ending inventory, look at your ending inventory. Had the lowest asset balance. Lowest ending inventory. Okay, it's a little more difficult to calculate and understand. Okay, and you might be thinking, why would any company even use this method? It's going to have low net income, low assets. It doesn't seem like companies normally want that. What it is going to benefit the company with is a lower tax bill. right? Because if companies are taxed on net income and their net income here is lower, they're going to pay less taxes in this time period. This is the second most popular method. A fun fact, though, about LIFO is that it actually is disallowed under international accounting rules. Disallowed under international financial reporting standards. So LIFO is only permitted for US GAAP. Okay, in US, we are kind of founded on this freedom, and FASB says, hey, companies should be free to pick the method they want. Whereas international rules say, I think it creates an unfair tax benefit. So it's disallowed under international rules. Kind of interesting. All right, our third cost flow assumption, weighted average. Okay, and again, if you go back to our example, you'll see weighted average was always right in between FIFO and LIFO for both cost of goods sold and ending inventory. So that's, again, one of its attributes is it's going to smooth out cost fluctuations on both statements, on income statement and the balance sheet, because inventory impacts both, right? So if you are in an industry where the cost of your purchases is constantly changing, right? It's up, it's down, oh my goodness, it's hard to predict. You might want to pick the weighted average method because it's going to help smooth that out. So it makes it easier for management to plan, and it might be less scary for some investors if they have more of a smooth change in net income instead of it being, really low one year, really high the next, etc. So that's the main advantage of the weighted average. Specific ID, it just really depends on, again, on the company, but it's mostly just going to be used. So we said it's less than 2%. Less than 2% of companies use it, and it's usually for high value inventory items. All right, see you in the next video.